Welcome back, everyone. Michael here with Offshore Citizen. Great to have you with us. I was asked by one of my followers on Twitter to share my opinions about the Dollar Milkshake Theory. Now, for those of you who are not familiar with it, it is espoused and kind of promoted by a guy by the name of Brent Johnson, who is actually really quite excellent as someone to kind of listen to. He's got a lot of good thoughts, a lot of good models, etc. He's a fund manager. And I think the things that I appreciate about him are, number one, he is willing to admit where he's wrong and correct his views, as evidenced. I'll talk about kind of how he came to this. And second of all, he is somebody who is willing to not overdo how accurate his positions have been. So that's very cool. A good example of this is the way that he came up with the Dollar Milkshake Theory. Was he was a pretty big gold proponent, investing in gold leading into, I think it was 2015, and then gold wasn't performing the way that he thought it would, and the dollar was doing better than he thought it would, and he said, well, hang on a minute, this doesn't fit my model. What am I missing here? And he went back and did a ton of research and came back and came up with what he calls the Dollar Milkshake Theory, which I will explain to you in a moment, and then I'll share kind of my thoughts on it and what it means for investing, at least from my perspective. So we're going to discuss that today. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you like our videos, please share them with your friends. If it is your first time here, welcome. We are Offshore Citizen, and we specialize in customized, holistic, international solutions for businesses and individuals, so we can help you figure out the right strategy and implement it. If you're interested, you can reach out to us through offshorecitizen.net, or you can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below. Okay, let's dive in. So, the first thing maybe to note is it's interesting to go and look at some of people's critiques of the Dollar Milkshake Theory going back to a couple of years, because things have performed fairly well according to this theory, meaning essentially that the US dollar has continued to do quite well. Now, if you want to follow this, you should look principally at what's called the DXY. The DXY is a chart which tracks essentially the dollar relative to a basket of other currencies. You can obviously look at it compared to any particular currency, but it's nice to look at it in the aggregate. And of course, the US dollar has outperformed most other currencies over the last quite a long period of time, last 10 years or so, barring, the ruble is a little bit artificial in the last year or so. It's done really well, but not in a real way, because you actually can't exchange rubles for dollars at those exchange rates in most cases. Second of all, the Swiss franc has done particularly well, and there's a couple others that have done well, but mostly the US dollar has performed really well. And I think the interesting point here is that a lot of people would have assumed, oh, look, the US is, falling or declining, let's say, as a world power. They are printing a lot of money, they're getting a lot of debt. Surely this should mean that the dollar is going to decline, right? And we have not seen that. In fact, we've seen the opposite. And the basic idea behind this Dollar Milkshake Theory is essentially that the liquidity is going to get sucked up into the US. And the reason it's going to get sucked up into the US is a couple different things. First of all, because in general, there's other countries who are also devaluing things at a rate which is greater than the US. And so we see a lot of this when countries will kind of start to suffer, and what do? They dollarize, right? So that's definitely the case. The US dollar and the US in general tend to be a flight to safety. And so as things get worse elsewhere, you tend to have more and more flows to the dollar. Also, as I mentioned in another video where I was explaining how I think the dollar will continue to outperform the euro, not necessarily in the short term, it's hard to predict the short term, but just in general, the US system is probably likely to attract more liquidity, and the US dollar is likely to outperform the euro over the next little while. The theory here basically being that the euro's interest rates are lower than the dollars, and so hence there's an incentive for people to put money into dollars versus euros, and that the US economy is stronger and therefore more resilient to interest rate rises, which means that they can afford to continue this, and this is the case. So he essentially suggests that this trend will continue. I haven't actually heard him say this, but I've heard some people say that that he thought that the DXY would hit 150. It's quite a ways away from that right now. but we'll see. I can't remember what the last time I checked it was. I want to say, was it once? I don't want to quote something. Anyway, it's a long ways away from 150, but it has risen a lot. And so, this would be a big deal. He figured that would go. He says, this isn't a good thing. He's not saying this is what he wants. It's not saying anything like that, but that fundamentally what this means is you're going to be in a situation where this will put pressure on other economies. And he thinks that actually whether other economies are defaulting or whether they are, trying to print out, etc., this is always going to, the liquidity is going to flow into the US. It is just the way the system is designed that the liquidity gets sucked up into the US, which is why he calls it the milkshake theories, because you suck up the liquidity, and sucking the liquidity is going to make this happen. And that this is going to go basically until you reach the point of a sovereign currency collapse. And that's not a good thing. This doesn't end well. He's not saying it ends well, but this is his theory. So what do I think about this? I mean, generally, I think that he's right. We generally do see the DXY is doing well. The dollar is doing well. The dollar is a safe haven asset. The US is a safe haven for wealth. I mean, if you just look, where are you going to put money that is safe? Okay. Because, okay, would you put it in Russia? That doesn't make a lot of sense. In China, it doesn't make a lot of sense. Japan probably doesn't make a lot of sense. Europe doesn't make a lot of sense. UK, probably not as much as the US. Maybe Switzerland, right? Partially explains why the Swiss franc has done extraordinarily well. In fact, the Swiss have started to buy, they basically deliberately started devaluing their currency, the Swiss franc. So there's a few cases like that it might do well, but where it can absorb the liquidity and where is going to be strong. Maybe you'll get something in the Middle East, but guess what? Middle Eastern currencies, such as the dirham, tend to be pegged to the US dollar. So that actually basically is just bolstering the dollar. You look at crypto, a lot of the liquidity in crypto has gone into US dollar denominated stablecoins, so that's boosting it. You could go into looking at like US real estate, US stocks. Okay, during the period of time when you're buying a lot of those stocks, this is going to push them up relative to the dollar. But overall, this is going to create a bunch of issues. And his other point is that there are USD denominated loans all over the world, right? And this is basically because many places do not feel comfortable, lenders do not feel comfortable lending in a currency they think is volatile. So for example, if you go and buy real estate in Turkey, you'll notice that it's basically US dollar denominated, right? All the details, they're not talking in Turkish lira. So even though the lira is devaluing at an incredible rate, you're not getting good property deals, right? So you have that sort of situation happening. This is true in a bunch of different markets, all right? And so where does this leave you? Does this mean that, the DXY is going to continue to grow in value exponentially until we get some sort of a collapse? And by the way, how would that collapse happen? The collapse is basically going to happen if the affordability of the debt, that is US dollar denominated debt around the world, can no longer be serviced. They have to basically have more and more money to pay for the debt, and this is going to cause issues. So here I think is where he is probably a little bit wrong. And it is, I think, when I try to observe, what you'll notice is most macroeconomists actually are really poor investors. And you can ask, well, why is it that most macroeconomists tend to suck at investing? And I think there's a few reasons, but one of the key reasons that I notice is they tend not to account very well for reflexivity. In general, I think people don't account very well for reflexivity. And so what is reflexivity? Reflexivity is the idea that something is going to go a certain way, but that's going to cause some sort of kind of second order thing that the market will be reflexive to, and it's going to cause a reaction, right? So a good example of this is if you were to go back to 2008, you would have various different people who are calling kind of for a doomsday scenario when we're going to go into a depression worse than the Great Depression, etc. And it turned out that didn't happen. Why? Well, because people don't just allow it to crash into nothing. That's not how it works. They do something about that. This was actually, I did a fairly good trade/investment back in, I can't remember if it was 2015 or 2014, August 24th, 2014 or 2015. Anyway, the Chinese market took a big dump, and I bought at that point in time. And the reason that I was confident to buy was in large part because I figured the Chinese were not just going to allow everything to sink, they were going to do something about it. And sure enough, the next day they announced, I think it was $300 billion in stimulus. And basically what had happened was the margin debt within the system had risen a lot. Previous to that point, it was out of control, and they essentially bailed it out and things leveled off and it was fine. So I think the same is true here when I think about the dollar milkshake theory. My theory, and this is only a theory, of course, my crystal ball is entirely broken and, I might be completely wrong. So, I'm saying this because of the fact that somebody specifically asked me about it, not necessarily because this is going to be what's going to happen, but you can take it as you will. What is likely to happen is, yes, there is continued pressure that's going to make the dollar attractive relative to other global currencies for the next little while. We are not at a point where we are close to the dollar collapsing, in spite of the fact that, yes, I think the US is doing a lot of things that damage the confidence in the dollar and make people want to go to other places. The reality is just there are not other places to go, at least with enough money and enough alternative security to justify that at this point. At some point it will be the case, but that could be decades in the future. We have no idea how long that will take, right? And it's amazing how central bankers have an ability to kick, and governments have an ability to kick the can down the road. What will happen, I think, highly likely though, is you're going to have this reflexivity kick in. And this reflexivity will correct and cause it not to be as extreme, or certainly not as quick as what it is that he's describing. What am I talking about here? Well, the first is when the US dollar goes up, goods priced in US dollars become more expensive. And goods priced in foreign currencies relative to the US become cheaper. What does this mean? This inherently means that people are going to stop buying from the US. That decreases demand for US dollars. And people in the US are going to start buying abroad, which is going to decrease demand for the US dollar, right? So that has this leveling effect. There's this expression in trading and in investing, which is the cure for high prices is high prices, right? When things get expensive enough, the demand for those things goes down and that self-corrects. So there will be some effect there. The second is something that actually happened in, was it the late 70s or early 80s? I can't remember exactly the dates. But basically what happened was the dollar was strengthening too much, and there was an accord that was struck between various different countries and the US, essentially to deliberately weaken the dollar. And you can go back and you can look at the DXY dating back to that point in time, and you can see how basically in the 80s it came down a lot and essentially bounced around within sort of a reasonable range at the time. And this was specifically brought about because these other countries knew the consequences of it. And I suspect the same will happen here. Just like Switzerland has started to deliberately weaken their currency, at some point the US will need to deliberately weaken their currency. There's lots of ways that this might happen. We can see things happening in Europe right now, and there's a possibility that the US will do some sort of a bailout, etc., for foreign countries, basically buying up euro loans, for example, euro bonds. I'll talk about that in another video. So this is a possibility. I'm not exactly sure how it will happen, but the idea is simply that the reflexivity in the market will counter out the extreme effects. In general, I think when you're trying to predict what will happen with markets, usually you can take the extremes and you can chop them off. And the reason is just because the worst case will never happen because of the fact that people will do something to try and prevent the worst case. And the best case will never happen because shit's going to go wrong, right? So you're usually somewhere within this bandwidth, and it's not clear exactly where you'll be. That's a difficult thing to predict. But there's this reflexivity that prevents it from happening. So anyway, those are my thoughts. Would love to hear yours. Put them in the comments below, and I will look forward to seeing you on the next video.